Cognitive error fixation is a type of cognitive error that occurs when someone focuses on one aspect of a situation while ignoring other relevant information. It can also be called tunnel vision. We're going to talk a little bit about that and India today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we take your questions about investing and options. Over the course of the weekend, I was contemplating the scale and the scope of the disaster that unfolded in Los Angeles last week. Some of you may know, and some of you may not know, that I actually met my wife in Los Angeles. I used to work there. I used to work for a firm called Ivory Capital. It was based in West LA. When I first started to work there, our office was at Wilshire and Ocean in Santa Monica, which is just below the evacuation zone that was delineated by a road up there called San Vicente. And so I'm quite familiar with the areas that were affected and know people who were personally affected, know people who have lost houses up there. And, you know, in the course of looking at that situation, it occurred to me that, there was a lot of information flying back and forth. What was really getting me kind of going about it was that I was kind of curious to know what insurance companies might have the largest exposure to the region. For those who don't know, who are unfamiliar with the insurance market in California, and specifically the one as it relates to fire insurance, what you may not know is that it can be very difficult in some areas to get fire insurance here. There's a couple of reasons for this. One of the reasons is a very obvious one, which is that there are regions here which are prone to fires. The climate here tends to rain in the winter, but during the summer months, you don't get any. And so things dry out. And you combine that with wind and an ignition source and some, dry brush, and it is basically a perfect recipe for spreading wildfires. The risk of fire, of course, is one reason why insurers wouldn't want to participate in the market here. But of course, at the right price, presumably they would. The problem is that sometimes you have policies which can reduce the steps that may be taken to mitigate fire risk. And then you have an ambitious regulatory body in the state legislature here, which has put some constraints on insurance pricing and made it uneconomic in many cases. So if you do not have policies in place which can help prevent fires, and then you constrain the premiums that insurers may charge to insure against the risk of a fire, you end up with what has happened now, which is that a number of insurers have left the state in whole or in part. If you've been following the news, you probably know that State Farm, which was one of the bigger insurers out here, actually was not renewing a lot of policies, and included in that number a number of policies in the Pacific Palisades area, and that was brought up. Now, what is curious to me, and the reason I brought up this whole issue of tunnel vision and that form of cognitive error, is that some of these policies, so if you have policies that are intended to have a positive environmental impact, if someone gets tunnel vision about that, what they might not recognize is the grander story. And actually, I have a spreadsheet up here, which I thought was just kind of interesting. Now, some of you may have seen a magazine called Harper's. They used to have something called the Harper's Index in that. And I always really enjoyed the Harper's Index, because what they would do is just throw some statistics out, and then people could just contemplate them themselves. So, for example, if we think about, you've probably heard in the stories about this, about the fact that the state of California has not built significant additional reservoirs in Southern California. So to put things in perspective, since 1974, so going back 50 years, the increase in reservoir capacity, mostly from raising the dam on some existing reservoirs, in the last 50 years, the water storage capacity in reservoirs in Southern California has increased. Round numbers, as you guys know, I like to just sort of work in round numbers, is about 300,000 acre feet, from about 2.2 to 2.5 million acre feet of water storage. That's since 1974. And over the same time, the population in that same region has grown from over 8 million to about 22, 23 million. So you're looking at essentially an increase in the water capacity of about 13% in storage, while the population went up by about 150% or so. Actually, so probably even more than that. Now, part of the reason for the delays in constructing additional water storage down there have been issues related to environmental impacts. Some of the reasons that some have stated, I don't know how much truth there is to this, that water, we had a lot of rain here in Northern California, but one of the reasons that some of the water was supposedly run out the delta in Northern California rather than channeled down to Southern California was for environmental reasons. Supposedly some of the controlled burns and fire breaks that were proposed were also for environmental reasons. But on my screen right now are some of the statistics regarding the environmental impacts of this fire. Oh, and one other thing I thought was kind of interesting. I got a tweet when I was just talking about the cut in the LAFD budget that Mayor Karen Bass had discussed, and we're going to get to some investments too, but was somebody said, oh, well, they still have an $820 million budget for the LAFD. So just a couple statistics about that I thought were kind of interesting, things to think about. Some estimates for the damages that were done that will have to be absorbed by insurers, reinsurers, homeowners, business owners, and the California Fair Plan, which is sort of the fire insurance provider of last resort. Some of those estimates are in the neighborhood of $100 billion. That works out to about $8.3 million per structure of the 12,000 structures that they said have burned so far. Of course, I'm sure that that estimate of the number of structures that have burned is going to change. But I thought it was kind of interesting when someone mentioned that they thought $820 million for the LAFD budget was quite a lot already. And considering they respond to, I looked this up, 500,000 calls per year, that's $1,600 per call. So that even if they had never dealt with this fire, I don't know, but dispatching several firefighters, paramedics, because 80% of their calls are for medical emergencies. They have 1,200 paramedics in the LAFD. Dispatching fire trucks, paramedics, and all of that, $1,600 per call on average. That strikes me as a pretty good deal. Especially when you consider how much it probably costs when they get those people to the hospital. So I thought that was interesting. Another way to think about the statistics is $100 billion worth of damages, even if the fire department did nothing else. If the only thing that the fire department ever did was prevent that fire from taking down all of those structures, that would be 122 years worth of LAFD budget. But of course, that's not all they do. They respond to 500,000 calls a year. So, you're dealing with 1,200 plus calls or whatever per day. And to the extent that environmental policy or regulation, made it difficult for them to do more to mitigate the hazards of the fire in the first place, I just did a little bit of calculations here. So what we're looking at on this sheet, if you can see it, is the greenhouse gas emissions for cars versus burning a house and building a house. And basically, if you do the work, essentially these fires, when you take a look at the greenhouse gas emissions as a result of the structures burning and what that kicks into the atmosphere, including woods, plastics, all of the other stuff that goes into it, plus the greenhouse gas emissions required to build a house in the first place. So steel and concrete are going to tend to be a little bit heavier in that area. Basically, this one fire offset the benefit of almost 1.5 million electric vehicles, which basically life cycle greenhouse gas emissions for electric vehicles is about half that of an ICE vehicle, because obviously you're still manufacturing steel, plastic, and all the rest of it, which is essentially the entire, it's more actually than the entire California EV fleet. So it does sort of highlight an important thing that, you know, policymakers have a tendency to do. People latch on to something and they make it an issue. But the responsibility of, say, the governor or the president, people in Congress, whether it's state or federal, is to try to take the input of people who have their attention very narrowly focused and step back and take a look at it in a big picture sense. Because sometimes if you do that, you find that efforts to solve a problem only make them worse for reasons like this. Okay, so I thought that was kind of interesting. I encourage you guys to do your own work on this, just things to think about. So I don't know if we're able to bring this up. There was a comment that was made last week after I was speaking about Johnson & Johnson. And Jay, do we have that? Okay, so it was not a question so much as it was a comment. And it is something I knew, but for whatever reason when I was talking just wasn't thinking about. But I think it is important. I was just making an observation that with Johnson & Johnson and the relatively low volatility and my concerns and considerations with respect to the pharmaceutical business, that Johnson & Johnson had more diversification because they had exposure to staples. But of course, as one of our astute viewers rightly pointed out, the company did spin the staples business into a separately publicly traded stock called Kenvue, ticker KVUE. And, I knew that, but actually I didn't realize or had not remembered that they actually divested the last bit of their exposure in 2024. I think it was in mid-year disclosure that the last, 10% or so of Kenvue that they owned, they had subsequently disposed of. And so that that does eliminate that one potential sort of aspect of the stock's diversification of their product offerings and stability that I was less enthusiastic about. And I mention this because, I have seen other pharmaceutical businesses that have seen some of their products come off of patent. They just didn't have a good pipeline, never really managed to figure things out. Probably the poster child for this is Pfizer. And it's one of the reasons why those kinds of businesses excite me a little bit less in general. And we can take a look at Pfizer here, and you're going to see that this is a company that just now we should probably ignore everything that happened during the pandemic because of course they got this ludicrous boost in their business as a result of the vaccines. But prior to that, we can see here that basically the top line was almost entirely stagnant. And, these businesses can be relatively stable, but if they don't have a good pipeline, it's never going to really turn into a compelling growth story. And that brought up, as I was thinking about that, something else that I thought was kind of interesting. Now, I'm not going to get into what my entire acronym for 2025 is going to be, but I figured I would bring up two things that I think are kind of interesting. And that is that those of you who watch know one of the things I'm most interested in is the relationship between the valuation for a security or an asset class and its rate of growth. And one of the things you can take a look at recently, which I thought was quite interesting, is that if you compare the equal weighted S&P, which I'm going to show here is the SPW index, but there's actually an ETF that tracks it, a tradable ETF that tracks it, one of which is RSP. But I want us to just observe something here, because this is going to apply both to this and to an international opportunity, which I think is also kind of interesting. So we're going to take a look at the growth in earnings for over the course of 10 years for the S&P versus its forward multiple. We're going to get rid of the price because I think this is kind of distracting. And we're going to go on a panel by field basis. So what I mean by that is that on the top here, we're looking at the forward price to earnings estimates for the S&P in green and the S&P equal weight in white. And then we're going to be taking a look at the growth in earnings per share for the equal weight, again in white, and the S&P in green. And this may come as a bit of a surprise to many of you, which is that, our general assessment is that one of the reasons, and there is some truth to this, by the way, one of the reasons that the S&P 500 index or the Russell 1000 index can be a very good way to invest on a set and forget basis is because effectively these two indices eventually capture the best publicly traded businesses that we have in the country. So they join the index, and as they grow, as they succeed, the companies become larger, and so their earnings growth more and more contributes to the earnings of the overall index. The best possible example of that most recently would be, of course, NVIDIA. So NVIDIA at this point, I think, is about 6.5% or a little bit more of the S&P. Yeah, okay, so 6.73% of the S&P 500 is NVIDIA, and NVIDIA's earnings have been growing by huge amounts. So that creates a huge tailwind to earnings for the index. And you can take a look and see that obviously there's some other earnings powerhouses in here that are contributing as well. But what is surprising is that if you actually take a look at the 10-year compound annual growth rate for earnings in the equal weight S&P, what you'll find is that it's actually growing at a rate that's about as good, or even in some cases better, than the S&P earnings have been. So you'll notice that over the last 10 years, compound annual growth rate for S&P equal weight earnings is a little over 8%. And for the S&P 500 overall, about 7.6%. And despite that, the multiple for the equal weight has basically been unchanged over this period. And one of the other things you'll probably note is this big divergence in the multiple. So, if we go back to, looks like, early 2018, you're going to notice that the equal weight S&P 500 index is trading at almost exactly the same multiple as the S&P 500. Now there's a 5+ turn difference, 18 times round numbers versus 23 3/4 or thereabouts, if we're just sort of looking at these roughly. And another way to think about this is, okay, well, let's just take a look at how far back that goes. So when were these two about the same? This was 2018. Let's go back. We'll look at 7 years then, sort of like this. Okay. So now I'm just going to compare the performance of these two over that time frame, and you'll notice that SPY total return 144% versus 94%. But a material portion of that, in fact, almost all of that, is coming from multiple expansion relative to the S&P 500. So if you are among the many people I've spoken to recently who are concerned about the fact that the S&P 500 has gotten exceptionally top-heavy, that, the MAG stocks are, disproportionately reflecting the index, these two things are becoming related to one another, I think you can actually consider looking at S&P 500 equal weight here, because you're not sacrificing a whole lot in terms of, over the long term, in terms of earnings growth. And so, and actually it's outperformed the S&P today. I think year to date they're almost neck and neck. I was looking at this earlier today. I think it was a difference of about 18, 19 basis points in terms of total return from the end of last year through today. But for your S&P exposure, if you are concerned about what's going on with, and I'm not saying that NVIDIA is going to underperform or anything like that. I'm just saying that a lot of these stocks have really done exceptionally well, and margin and valuation expansion, so the multiples that these things are trading at, has contributed to the outperformance of the index, and that does not go on forever. That's not to say that equal weight doesn't have its own potential headwinds. One of the other things I was going to bring up was just global economic growth forecasts, and the fact that it seems like the jobs data that we got and inflation data that we've been getting, that even the possibility of there being no rate cut in 2025 is now being bandied about. And that's obviously a problem for risk assets generally. But another area that you can consider is India. So, we've talked a little bit in the past about the challenges that are related to China and people looking to divest from China and move elsewhere. The fact that they have this demographic inversion going on, where their population is aging, largely due to their one-child policy. India is a potential beneficiary. Oops, I went to the ETF. That's not what I meant to do. I have to go to because you can't get the fundamental data off of the ETF. Doesn't work that way. So this is what I actually wanted. So here too, we're going to look at, so you can, RSP is a way to get exposure to the equal weight S&P 500. INDA is one of a couple India ETFs, but I kind of wanted to show this the same way. And that is just to take a look at the growth versus the multiple. So here you're looking at a multiple that is indeed much closer to that of the S&P 500. But it's, right now the economy is forecast to grow at about 6.4, 6.5% year on year, according to the World Bank and some others. So we've got earnings growth, compound annual growth rate in the neighborhood of about 6.8%, which, by the way, is also what Prime Minister Modi was forecasting when he was speaking at this youth conference in New Delhi yesterday. So he was forecasting that GDP for India, which I think is around 3.6 trillion US right now, that their expectation is it's going to grow to 10 by the end of the next decade. So not by 2030, but by 2040. But that works out to an annual compound annual growth rate in their economy of, about 6.3% or so. And if their stocks will behave in ways that are similar to the way stocks have behaved in other economies, generally the best companies will grow faster than the economy does, and the best companies' earnings will grow faster than their top line does. So when you put those things together and you say, okay, take a 10-year look into the future and what do you expect, even if we handicap some of those forecasts somewhat, then you're getting very favorable price earnings growth for Indian stocks over the next decade or so. So, like I said, a way you can play that is with INDA. All right. So, having thrown those things out there, things to think about, I also wanted to just quickly see what kind of questions we have here. So, Bunny23, I don't know that we've gotten a question from Bunny23 before that I remember. Europe is going to buy more LNG from the U.S. As they are no longer getting natural gas from Russia. Which stock will be a better buy? EQT versus Cheniere. Well, yeah, Cheniere is usually the first one that you think about when we contemplate this. So why don't we just compare and contrast these businesses really quickly? I mean, I definitely think that just in terms of flexibility, we are the largest energy producer, 22-ish million barrels of oil equivalent. 13 or 14 of that is crude. We actually were briefly a natural gas importer from Canada, but fracking has completely changed the landscape, literally and figuratively, with respect to the natural gas markets. But let's just take a quick peek here. And you can see, if you take a look at the difference in prices in natural gas between the U.S. and Europe, what the opportunity is. This is a situation where, unlike oil, which is much more of a global commodity, because natural gas is much harder to transport, there's a much bigger divergence between prices for natural gas locally. So, as you can see, and of course, these are businesses that are going to be impacted most directly by prices locally for now. I don't know exactly. Let's see what the anticipated capacity for export is. So they have a capacity to export about 45 million metric tons from the Sabine Pass and the Corpus liquefaction facilities. So let's take... the nice thing here is that if you're looking to play Cheniere on this opportunity, it's really not trading at a insane multiple to begin with, right? So you're looking at, it's not even really trading 20 times full year 2025 estimates. Although, in fairness, the whole space is typically trading at a discount. Oil services is trading at quite a big discount. Let's see here. So, obviously, EQT is trading at a slightly higher multiple. They currently have capacity for a half a million tons. But they are, they're building out their Texas facility. So when is that going to be coming online? Looks like 2028. So I would say this. I think, both probably represent good opportunities. I think LNG is a little bit more... LNG, well... I think Cheniere is a little bit more turnkey. I'm referring to them as LNG because that's their ticker. But Cheniere, I think both are probably decent plays here. But I think Cheniere is probably going to have a more immediate potential benefit. Let's just take a look at it from an options perspective too, and see what we think here. So a couple of the things that I'm usually interested in is, number one, how volatile is the stock compared to what the options market is implying, and what does the term structure look like? Because what I really do like, if there's a decent opportunity, is getting those calendars into play. And so let's see when they're going to be reporting their earnings. So Cheniere is going to be reporting Feb 21st. Oh, that's interesting. I mean, one of the issues, of course, is that we have the Jan regulars. Those are going to be rolling off at the end of this week. The other problem is that they don't have weeklies. So this is definitely one of those cases where you want to make sure that you're using limit orders when you fire these orders off, because just if it's a little bit more thinly traded, sometimes the spreads can be a little bit wider. So you want to be a little bit more careful there. But I like this for calendar call spreads, for diagonals, and the volatility that you want to get. So let's just take a look at the. So I'm going to get rid of the options premium picture here. So as high as 32 there. Let's go back a couple of years. Yeah, so I mean, if you're getting, if you're collecting, in this neighborhood, 35% implied volatility, that looks like it's a reasonable sale. And let's see where the Febs are trading right now. Mid-market. It's a little on the cheap side at 26. What about the longer dated? Yeah, so actually I think I'd be more of a premium buyer to make my directional bets here, because you're paying about 26 vol, which seems relatively reasonable. I think either of these are probably decent plays, to be honest. I think I like them both. I actually kind of like energy as a catch-up trade, underperforming sector overall last year. But I do think that some of these things, and look, they're going to trade on the promise even as they develop their capacity. So it's not this, bear that in mind. It's not like you have to wait until all of the terminals are completely constructed and the ships are on their way. There's going to be an opportunity before that happens, because investors are going to catch it. And then neither of these are trading at an obscene multiple as it is right now. So that's my thinking there. Let's see. All right, PC. When to run a long call 4+ months with selling short-term tight strangle, which is a call spread risk reversal, diagonal call spread risk reversal, bullish on Goldman Sachs. What's a trade? Yeah, so, well, this is actually the kind of thing that I want you to look at when you're doing that, right? So look at the term structure. This is all else equal. This is kind of the setup that you want, bearing in mind that we know that the reason that the front end of Goldman Sachs term structure is strongly bid right now, because the company's going to be reporting earnings. All the big financials are going to be reporting earnings, and so you're going to have a bid to it for that reason. So they report on Wednesday, and for the same reasons that I've talked about before. So this has an implied move of 4%. Let's take a look at what the straddle at the money straddle is for this week. So the stock's 563-ish, 565s. We'll use that. So it looks like it's about $25 for the straddle, maybe a little bit more. Call it 26. Yeah, so about 4% for the straddle, which means that if you buy a longer dated call option, what are you going to get as a percentage of the current stock price to sell these Jans? I think I would probably be inclined to buy the longer dated call Now, of course, if you sell, the nice thing is that if you sell a strangle, the stock can only be higher or lower when that strangle expires. So even if you get it wrong and it runs through, you can still collect a decent amount of premium. And actually, let's just mock this up really quickly. However, I will say that I don't think there would be anything wrong with just waiting until earnings come out and before selling premium against it. You want to make sure that you buy premium if you are going to get long a longer dated call. Make sure you capture both this earnings and the next one, because the vol suck, that is the decay in those longer dated options, is going to be pretty profound after they announce earnings. So it just makes it a lot harder to get the trade right if you do it that way. But let's just mock this up, assuming that you put the trade on tomorrow first thing. So the next estimated earnings after Wednesdays is on the 14th. Okay. So we could buy... These will capture it if you wanted to go out that far, or you could go a little bit further, which I have no problem with either. Out to May or June, if or beyond, actually, if you wanted to. But let's just, for the sake of argument, we're just going to grab the April. So buying the April at the money calls, 565s, and then selling. I'm going to put January in here, some nearer dated stuff first. So I'm going to add a short put, add a short call. And going to make it at least that implied move away. So I'll make it 4.5%. Why not? Let's see if we can get something attractive out of it then. So that's going to be $28 one way or the other. So that's going to be not the 500 puts, but probably something more like take these up a little bit. It's going to be in this neighborhood. You know what? We'll go like this. 525. And then we'll take this up. These are going to be the 600 plus, so maybe 605. So you're going to end up with a trade that looks a little bit like this. So that's a diagonal call spread risk reversal. And my expectation would be that the decay of this short strangle is going to more than offset the decay in that longer dated call if you bought it. So this could be one way to set it up, and I'll just put this if you want to see. So what we're looking at is a long April 565, and then selling the Jan 31st month ending 525 605 strangle. And wonder how much less you would get if you took that to just this week, so that you're only playing with that. You can see here that offset is relatively modest. So doing a 1 week strangle is not really going to. I mean, you're only going to be offsetting about 10% of the premium. And usually, I'd like to, if I'm going to sell premium, if I could get at least 25% of what I'm buying. In terms of collection. So, and I don't know that going out even 1 week to next week is going to accomplish that. Let's see, 5, 15, 20. Yeah, so it's really going to have to be out to the end of the month. By the way, another thing that can be done is, for those who might be thinking, oh, well, I'm not quite so bullish. One of the other things that can be done, of course, is to do a strangle swap, kind of like this. So buying a longer dated strangle, put, call, what do we got here? Do I have them all right? Short, 525, 605, 610. That, and this needs to be April. And you get a trade that looks a little bit more like this. And those can be a very nice setup as well. These I've used these many times. Even when I'm generally bullish, I have used these because they tend to make the most money at the upside target price. But it's kind of nice to have a trade set up that can work if you get the direction wrong going into a catalyst like earnings. So I'm more likely to use these kinds of directional bets in a catalyst if I'm not that sure. I will make the following point about these. Generally, I have found that when you do this kind of a strategy, if it runs to your long strike, make sure you adjust those other strikes quickly, because I've seen sort of, a vol suck take place over a day or two, and then I often had an opportunity to monetize the trade better straight away, even than a couple days later, because the front month options are going to just get crushed in terms of their extrinsic premium. That's just going to get completely eviscerated. So that's something to think about. All right, JBow, EIX was down almost 30% since the LA fire. Is it too early to bet for a rebound through call spreads? Well, yeah, this is, so let's take a look at the charts here. And, we also should probably take a look at PG&E and how that one did after the Paradise Fire. So for those of you who are wondering what's going on here, there's basically three big causes for wildfires that happen out here. One is lightning strikes, and there were no lightning strikes associated with the fires in LA. There was no lightning or that type of weather detected at the time. The other is from down power lines. So when power lines, get knocked down by the wind or a tree falls on them and then live wires hit the ground, spark ignites the underbrush and the wildfire begins. That's what happened in the Paradise Fire. And then, of course, the other most common source is human, usually accidental. Campfire, cigarette butt, whatever, something like those. A gender reveal party gone wrong. These are all things that have been known to happen. So because there was no weather, and because some of these fires originated away from sort of main roads, there was some speculation that, and there wasn't evidence actually of downed wires, so another idea that has been floated out there was that transmission lines in high winds may have come into contact with one another and then shed hot sparks in that way. However, I think that, yes, and so I see Tucker the Dog is saying, thought at least one, Eaton maybe was suspected arson. So there, the fact that these fires were popping up in multiple locations well away from one another. So the Eaton fire was the one that affected the Altadena, Pasadena area. So that is an area that is northeast of downtown Los Angeles. The Palisades fire, for those, again, I know some of you are going to be very familiar with Los Angeles, so I don't need to tell you this, but for those that don't know, Pacific Palisades is, almost as far away as you're going to get along the 10, which is the corridor that connects downtown Los Angeles to the beach. If you're going to just, head out to Santa Monica, that's a good distance. So burning embers, even with fast-moving Santa Anas at, call it 40 to 70 miles an hour, there was one recorded gust that I'm aware of that was 100 miles an hour. But those are probably going to travel 2 to 3 miles at most, usually, even possibly as much as 5. But the distance between the Eaton fire and the Palisades fire was greater than that. And also it was the wrong direction, because the Santa Anas are an offshore breeze. So the wind is actually circulating around and it's coming from the northeast and blowing to the southwest. So a fire that was in the Palisades, even embers being carried by such a fire, would not end up 10 or 15 miles to the east. The wind is actually blowing in the opposite direction. So they wouldn't go that far under the circumstances, even if the wind was going that way, but it wasn't. So that we can essentially, because of that, it's very likely that the origin for both of those fires was not the same. So yeah, Tucker D Dog commenting that suspected arson. It's a possibility. You know, I think some people suspected. You know, there was a homeless individual who was caught with a propane torch trying to set Christmas trees on fire in the valley. So you know, if you're envisioning Los Angeles, you know, and I'm trying to think about this. So what you're seeing, so it makes some sense. But if this is the ocean over here, so all the way to your west, I'm trying to think about it from your perspective. You're going to be looking at me this way, and downtown Los Angeles is over here. Then where the homeless guy was caught was up here in the middle over the Santa Monica Mountains. And there were a couple other fires that were up in the valley over here. I think one near Santa Clarita and a couple other areas. But basically, it is possible that those were arson, but it is also possible that they're going to find out that it was a transmission line. You can't really get any money from a homeless person who sets a fire. But if you take a look at what can happen to a utility, if they are found liable, which was the case for PG&E, then you'll get something that looks a bit like this. So we're going to just blow this up here. So this is in and around when the fire, the Paradise Fire took place. This was the big one. Very deadly. Movies have been made about it. A real mess. And what was happening was that, some older, they had some lines that went down. And actually, for what it's worth, this is also one of the reasons why the utilities in California, oftentimes when the wind starts blowing, they knock the power out proactively in case something knocks over power lines so that a fire doesn't get triggered. That's one of the reasons they do that. But if you were looking at Edison, EIX, which is what you were, this is what you're afraid of, that they get sued into oblivion, that they get sued into bankruptcy. And that's what happened here. It's not as clear to me that that's going to happen, and they're still doing this work. So it's interesting, though, to me that in the case of this fire, people are very quick, as you've seen. If you've been watching the news, people love to jump to conclusions before all of the work has been done. And, Michael Anthony joining us. MFA. Yeah, we talked about that one a couple times. I'll get to that. Yeah, so my thinking on this is that I have not yet seen or heard anybody indicate that this company is at fault. It has lost a lot of value on the possibility that it might be. If they are, the damages are, it could be the end of the company, right? At least, it could force a company like this into bankruptcy. So that's how bad it is in terms of the potential financial impact. For perspective, we can look at this and just say, okay, well, look, this is a company that's got $17 billion a year in anticipated revenue for this year, 18 for next year, and we're dealing with damages that could be up in the $100 billion range. By the way, those damage numbers also are not, I don't have a firm number on it. That's $8.3 million per structure at 12,000 structures. And I'm not sure that's certainly not representative of the average structure in the Altadena. That's the Eaton fire, and not for most of the Pacific Palisades area either. There is obviously a lot of other damage that goes along with that, other than just the individual structure fires, contents. There's going to be infrastructure issues. It's just a massive, massive thing. So, but my point is that if you have a company that's got $18 billion in revenue and you're found liable, even partially liable for damages that great, and then you slap in some kind of punitive thing, then that's the end of the, That's the end of the equity. There's $22 billion worth of equity that could get wiped out very, very quickly. But I only mention that so that you're aware of the potential extreme. But I haven't seen anything concrete that ties them to this. And the fires have started in different locations. And so, yeah, if you want to speculate on the long side, let's see how much vol has popped in here. Quite a lot. What I would suggest is maybe 1x2s. So check this out. Let's see if I can, where did I put this? All right, so vol is going to be higher. If nothing happened, is the stock going to get way beyond where it was before? I think that's unlikely, right? So let's call it, it's not going to get back up to, call it $87 simply because it turns out that they weren't responsible. There's always going to be some overhang until all uncertainty is eliminated. And so at best, I think you could forecast that the stock might get back to where it was beforehand, assuming no evidence is found. So you combine that with the fact that the implied volatility is considerably higher now. And one thing you could do is say, all right, well, I want to buy some upside calls, and I'm going to sell more of these higher strike ones to offset that additional premium, knowing that the likelihood that the stock's going to get beyond where it was. So you can see the break even here on this trade is $78 to the upside, which is about where the stock was right here, right after the new year, before all of this took place. So your profit zone is going to be in this area, and your absolute risk to the downside is going to be about $200 if you did this 1x2. So this is something you can think about as you make these types of plays. Another way to do it, of course, this is another potential way to play for a, use a calendar. So, maybe some July 60s, could buy those and then sell something near data, because my guess is the term structure is going to be pretty inverted here. We can validate this. Oops. Here. Yeah, so this is also inverted. So that's another thing you can potentially do. Buy some longer dated calls, sell some near dated stuff against it. Maybe sell some Feb. You want to go higher, of course, like this. So, here again, you're gonna offset a lot of the cost by selling some of that elevated short-term premium, knowing that the chances that the stock actually somehow gets above the level where it was before all of this happened is quite low. So that's just a way to trade around a catalyst where you know that you've got overhang, you know why you have that overhang, you know what might potentially alleviate it, and you have some sense of where the stock might get back to in the event that it proves that it turns out that they didn't have anything to do with it. And of course, there were a lot of fires there. So that's something else to think about. So Michael Anthony, you've asked about MFA a few times, and it seems like a couple of times we talked about it here. I'm not going to get into it at great length. You can always go back and watch recordings of the earlier one. But I like it. That's the short version. One of the reasons it's trading at half times book is just because everything in the fixed income space has been very hard hit since rates went higher. And of course, they've gone higher again this last week. I also was a little bit concerned, as I mentioned last week when you weren't watching, that they had taken on a number of notes at an average interest rate of about 9.3%, which struck me as kind of speculative. But having done a little bit of homework with some people that are in areas like hard money and so on, they said that actually those things are usually better collateralized than you might otherwise think. So I like it. And if rates do end up coming down, they're poised to benefit, and you're going to get a nice yield in the meantime. Okay. So that's going to be that. We're not going to bring up MFA anymore there, Michael, until their next earnings. Okay, let's see. Here we are. Do you have any thoughts or insights on how the economy would be and any effect on energy markets if Canada reciprocates Trump's tariffs? Thanks. So, a few years ago, this would have been a more profound risk for the United States when we were actually a net gas importer from Canada at that time. But that's no longer true. We do need to trade, or we would like to be able to trade the energy we produce based on our use. What do I mean by that? So, in really simple terms, imagine you're France, and France has a much higher percentage of their vehicle fleet are diesel vehicles. When you refine a barrel of crude oil, about 25% of it is refined into diesel, 50% into gasoline, and so on. And then maybe you have someplace like the United States, which is virtually all gasoline-powered cars if it's internal combustion. So other than the transportation industry, busing, trucks, trains, things like that, for passenger cars, we're all gasoline. So you have two different populations with very different fuel mix use. And so each could have enough crude in theory, but when you refine it, they don't actually have the products that they want. So, we could ship diesel there, they could ship gasoline here, that kind of thing. So with respect to Canada, we're not dependent on them the way that Europe was on Russia. And so consequently, I'm not terribly concerned about the tariff considerations on the energy front for North America, because if you're just handling stuff on swap, I imagine that that's probably not going to be a problem. What is interesting to me is whether they could reinvigorate potential pipelines, which were being contemplated before the Biden administration came in. That would really be a positive for both places. If we had a better pipeline infrastructure, it's just a good idea. I'm in favor of this, so that could potentially be a benefit. There is something else, which is that when we talked about tariffs and Canada in prior videos, this was before Trudeau had resigned as the head of his party and is ultimately going to get replaced. And I have a feeling that whoever replaces him is probably going to have a better relationship with the incoming administration than Trudeau would have. Would have. So I'm not terribly concerned about it. I'll put it to you this way. And of course, maybe the biggest reason I'm not as concerned about it is because there are few things better for us strategically than to be energy independent to the extent that we can be. Even if it's not quite the product mix, like I said, that we want. If we're generating as much energy as we use in terms of fossil fuels, that's a good place. Continue to try to improve your storage and efficiency, broaden out to other other energy renewables if you can. But the fact is that I think compared to a lot of other places, we're in good shape. We're in better shape than China is on the energy front. We're in better shape than Europe is on the energy front. And Canada would, they're going to benefit from their relationship with us probably more than the reciprocal. So yeah, I'm not terribly concerned about it. Hope that helps. Sure. We had another question. What was that question? Okay, we had a question which I can't pull up on my machine, but it is from okay. Ranjana, so Ranjana asked the following question. On Friday, January 10th, I made the following three-legged trade on WSM. So let's load the trade up and take a look. So I sold 1 February 175 put. So we're going to put that in. Sold the 175 put. Okay. I bought a May 195 call. All right. And I sold him a 220 call. Okay. Like that. Is there anything else to it? Net cost was 840. Net cost was 848. Really? Did I load this properly? Stock's down a little bit. So the mid-market price on that thing's about $600. And the stock's down $1.60, and that shouldn't be 100 delta. So I don't know what the price of the stock was when you executed the trade. But let's just take a look at the characteristics of the trade as of the current prices. So nice probability of profit, 70%, as you can see here. I will make one point, which is that I generally prefer to sell nearer dated premium than that. So I might have... This is not a terrible trade, and actually I had a colleague who used to do this kind of stuff quite a lot. Because literally would take a fundamental view on a stock, say this is where I think the thing's going to be at the end of the year, and would set up an options trade so that basically it would profit if it got there, mitigate a lot of the potential downside if it just went sideways or traded lower, and was happy to do a long dated spread, set, forget, and really didn't focus that much on the day-to-day swings in the P&L. Although there were circumstances when if things really moved and got away, the trouble with it was that there could be some liquidity problems trying to unwind the trade at levels that seem favorable. But in general, I don't mind that trade that much. Now, of course, you have this other circumstance which probably encouraged you to do this in the first place, which is that the stock had this big pop in here. And so, doing a call spread risk reversal, which is, this is a kind of a diagonal one, that can be appealing because at the very worst case, you'll be put the stock at, a 10%, more than a 10% discount to the current stock price. So let's just take a quick peek at Williams-Sonoma's fundamentals here. Let's see and we'll take a look at the technicals too. All right, so on the technical front, kind of a mixed bag, but it would seem, let's see here. That looks like it's fairly mixed. I like to look at it versus the 150. Have it brought on by, and of course, because of that big breakout, I'm going to try to extend this and just see how far above that it has gotten in the past. So, yeah, maybe one of the reasons that also encouraged your trade is that once you get these kind of big breakouts, you can have some periods of consolidation. We had one here that lasted for about half a year. So I'm not saying that's what's going to happen here, but that's one possibility. And we have earnings coming up on Jay's birthday, or that's the estimate anyway, March 13th. And let's take a look at what's been going on here. 847 is the coming year's EPS estimates. So 23 times. Yeah, I mean, I like the structure. I would probably contemplate the next time you do that trade, think about shortening up the expiration on the short dated upside call that you're selling. So, either doing strangle swaps or long call versus short strangle, that kind of thing. I might prefer that a little bit. But otherwise, yeah, I'm fine with the trade. And as you saw, the probability to profit is pretty good. So I hope that helps. So let's just quickly scan this. Okay, I'm just going to answer these last two questions. So, Out of the money, MicroStrategy, long puts and have been selling short puts against them. Okay. Implied volatility in the name has come down since. Thoughts on the possibility of getting enough short premium over time to make money? Okay. You did not specify what the expirations were, but I will say this, and that is that if the term structure is flat to downward sloping, and we're going to get rid of this. So as long as you're not selling, for example, like these Jan 24th weekly options are, lower vol. So just make sure, as long as you're selling near dated premium at an implied volatility that is at or above the longer dated stuff that you own, there's a very good chance that you're going to get a good offset on the premium, right? Just not if you have a steep. So if the term structure is very steep, meaning that the long dated trades at a big premium, that's when you're going to run into that problem. But in this situation, assuming you avoid these expirations that are lower, you're not going to have an issue. And then Michael Anthony, Herbalife, last earnings almost doubled and raised the outlook, which has so many insiders buying. Why the shares near lows? Okay, so Herbalife, for what it's worth, that's LA-based company. If you don't know the company, it's a multi-level marketing organization. I'm not crazy about the company and their business model. And that's not because they don't deliver, as you can see here, the street's looking for $1.94 a share next year. This thing's trading low single-digit multiples. Why? This is the company, if nobody remembers, that Bill Ackman shorted. And one of the reasons he shorted it was because he described it effectively as a pyramid scheme. That the only reason that the company is able to sell things like their nutrition shakes and things like this is because they get people to join the organization, buy a lot of the stuff, and then sell it, recruit other people to sell it, and then sell to them. Of course, that is a multi-level marketing organization's business model. Amway is the same. Mary Kay. There are other businesses that have succeeded in this area. There's a number of them. But that is to say, Bill Ackman's allegation was that the company was hurting the participants. For those of you who followed the story, you will also remember that Carl Icahn recognized that Bill Ackman probably shouldn't have gone out and advertised that he had shorted 20% of the company, and he recognized that he could probably squeeze the stock, and that's exactly what he did, and effectively forced Ackman, out of the position. If you were looking at only the numbers, if you just looked at their financial statement, this thing would appear to be a screaming buy. It's generating, what have we got here for a free cash flow yield? It's a big number. So free cash flow yield is 27%, although they carry a decent bit of debt, as you can see, about $2.5 billion. And, the thing is trading at 3.4 times next year's estimated earnings. I say next year, but it's really this year. So we're going out to the end of January. The issue here is it's all about the business risk associated with their business, being a multi-level marketing organization, and whether people think that someone's going to essentially put them out of business one of these days. I will say that many years ago, we owned shares in the company when I was at the hedge fund in LA. Company was a much more valuable business back then. Hadn't really delved into it. That was actually well before all of the Bill Ackman controversy. But having seen his presentations on it and done a little bit more work on it, the reason the thing is trading so cheap is because some people they find the business really unappealing. And if you think a business might be hurting their customers, if you will, then there would be a good reason not to buy it. I'm going to leave that to all of you to judge on your own. The company has its supporters as well. I think there was a video that came out that was all participants in the organization who loved the shakes that they sell and felt like their life had been changed by the company. So I'm sure some people's lives have been changed for the better. But to me, it has enough hair on it that it's just one that I wouldn't touch. There's enough companies out there to invest in where you're less concerned potentially about that kind of a risk. So that's an existential risk if let's say a regulator comes after them, and it seems to be priced that way because I don't ever remember seeing it trade as cheaply as it does right now. But then there's also the moral and ethical question. And I'm not saying it's immoral. I'm saying we each all have to make our own judgments about a company's business practices and whether they're consistent with our own values. In this particular case, they're just not consistent with mine. And so I wouldn't do it. If I thought that they actually had a sustainable long-term business model, this thing would be an absolute screaming buy. So that's where your decision is probably going to be affected by this. If you disagree with my assessment about whether they really are a benefit to all of the stakeholders, go forth and prosper. But I can't recommend it because I'm not all that enthusiastic about it. Anyway, no judgments, right? That's my judgment. It's a judgment. There are a lot of them. That just happens to be mine. So I hope that helps. And Tucker D. Dog makes a really good point here, which is that countless protein shakes and this, that, and the other thing. And I see this with my own teenage kids, that it's a lot harder to go door to door humping some kind of nutritional shake when people can come up with something on TikTok and say, this is the bomb, and follow my affiliate link, and nobody has to sign up and get some kind of long-term commitment to buy a garage full of this stuff. So it is also possible that just from a modern marketing perspective, that the multi-level marketing business model is less appealing now when social media has such an impact on the sales of nutritional supplements and that kind of thing. So that's a very good point. I'm glad you brought it up. So with that, I have chewed up more than the designated hour that I usually take, but I wanted to take those last few questions. And I see that there's another one here that involves ConAgra, Kraft Heinz. Yep. And so I am going to address that, Michael Anthony, on the next show, which we're going to do Wednesday at 4:15 Eastern Time. Like, subscribe, notification bell, tell your friends, and come back on Wednesday, and we'll talk about some of those other companies. Thanks for watching.